Welcome to TheoTrade. This is Don Kaufman. Here we are. It is April 26, 2017. First, I'm going to cover a little bit about the broader markets, the S&Ps, the bonds out there, talk about the expected move. But then we're going to get very specific and discuss a couple of earnings-related trades. Google, Amazon, Microsoft, Starbucks, all coming out with earnings on Thursday after the bell. It's the single biggest individual earnings day really of the season outside, of course. Yeah, hey, Apple's exciting, but when you get Google and Amazon releasing on the same day out there, throw Microsoft in, you have the makings of what could actually move markets. But first and foremost, let us talk a bit about the SPX and the move that we saw in today's trading session. So obviously the new Trump tax plan is released today, I guess, and I put a question mark on that because they released some of the details, but the details were very, very minimal. And frankly, the market had no idea how to price this in. So let's go to some of the intraday trade to begin with here. If you take a look at the S&P, specifically the E-mini S&P futures, you will see the time of the release, of course, of that tax plan. It's right in this neighborhood. The S&Ps initially spiked, they sold off, they spiked, they sold off, and then we actually faded hard into the close. It's not the S&Ps that were concerning, and the S&Ps did not surprise me at all today, and I'll show you why here momentarily. It's the movement in the bonds, once again, that we have to keep an eye on. Okay, this week, Monday, Tuesday, okay, we saw a fairly wild rally to the upside inside of the S&Ps. Okay, at the exact same time, sure, the bonds backed off a little bit, okay, but I need everybody to keep in perspective that the bond market, and I'm going to go in here and I'm going to go out and contract adjust it. So adjust for contract changes, hit apply, hit OK, done. Okay, the bond market as a whole residing above this very specific level of 152 even, I think is a critical juncture, and anything above 152 still has that, you know, the market still has the propensity to be able to get whacked and whacked hard. Now, listen, I've been bearish, and have we been wrong? Well, the market hasn't done much of anything, okay, in the last couple of months. We're all pointing to on Monday, we exploded to the upside. Tuesday, there was some follow through. The bonds, though, they remain in a highly elevated posture. So keep that in mind, because I look at this as a risk mitigation tactic from the trading world. Now, as I was saying about the SPX, has the SPX done anything astounding over here? Well, again, we've been bearish for quite some time. What's new? Okay, we've moved off this 2350 marker inside of the SPX. Here we are coming right into the expected move. Now, let me refresh everybody's memory with this. Okay, if you go to the Analyze tab and you go over here to think back, all right, and we go right to the Sunday night. Why am I going to Sunday night? Because I want to remind you, the expected move for the week was $47. It was $47, and again, I want to highlight this very, very specifically. There's $47 based on a product that was trading at $23.48 and change, which ultimately brought us, okay, to the hash marks that you actually see on the screen. The hash mark down below here, and again, I'm kind of highlight this. That hash mark right there, 23.49. This little hash mark right there that we actually cracked into today is 23.95. It's the upper edge. That's the upper edge of the expected move. And what's notable about it is that we actually touched it today, crest through it for a matter of moments. Now, if you take a look at this on intraday trade, right, shot above it momentarily, okay, but closed solidly below it. That's exactly what we talked about Monday, that if we actually hit the upper edge of the expected move, that it was possibly a tradable top and that we could fade the move over there. Hopefully people not only understood that, but did trade off of it, because later, obviously in today's trading session, we touched it and failed miserably off that. You can even see the spike in the volume in the S&P futures. The S&P futures have a slightly different pricing, but right in the neighborhood of 23.91 is the effective edge of the expected move. And of course, it held today with some sell side activity into the close. Largely speaking, though, the S&Ps are massively unchanged in the day. Nasdaq futures got whacked a little, but the Russell still strong on a relative basis. Again, what's really catching my attention, it's the bonds. They remain in a highly elevated state. Okay. Also on Monday, we discussed, of course, the XLF hitting this kind of fateful number of 24. Well, guess what? We crested into 24 and we failed twice off the 24 level. Again, critical levels inside of the markets being breached and ultimately coming underneath. Now, let's get to some of the earnings trades. Okay, how do you actually talk a little bit about earnings? First and foremost, Google. If you look at Google on a much broader time frame, we're going to bring Google up over the last 3 years. It's fairly evident, okay, that when it releases earnings announcements, they've been positive on a relative basis, or have they? Okay, when you start looking very, very specifically at some of these earnings announcements, here's an earnings announcement. We ultimately traded down, okay? And we'll start scrolling through. Here's an earnings announcement. We didn't do much, traded down the next day and then rallied thereafter, okay? Here's an earnings announcement coming up. We actually bounced to the upside, okay? And again, as you start going through earnings announcements, well, I have a piece of technology and I did this. And what I found out inside of the earnings, and again, I'm going earnings period by earnings period. Here's an earnings period. We gapped higher and then faded substantially after it. Here's an earnings period, obviously gapped substantially higher, okay? But when I zoom out on this and you look at it, you immediately think, no, Google always trades higher on earnings. But you're not going to see that if you actually look at the data. If you really start to dig deeply into the data, you'll see here's Google earnings, stock getting whacked. Here's Google earnings, stock getting whacked. Here's Google earnings, stock traded up. Here's Google earnings, stock actually getting whacked. And what I actually found, here's Google earnings getting whacked. It's pretty much a 50-50 bet out there. So what I did is I actually went through and I looked at Google, and then I went over and I looked at Amazon, and I was doing some of the same exact analysis in terms of Amazon. Oh, there's Amazon getting whacked after an earnings period. And I only used 3 years of data, which, again, is that a little bit shallow? Okay. Yes, it's a little shallow in terms of the number of data. Here's earnings in Amazon. It's stock getting whacked down. Okay. And you can come into more recent periods. Here's where it's starting to gap up. All right. Here's another massive gap up. All right. Here we go. Here's a gap up and then fading off of it. That's an interesting one, but we definitely gapped up from earnings. Again, here's a gap up. All right, and we continue on and on and on. Here's actually gap up and fade hard the next day. It's actually a down move. This is actually a gap up. So when you start looking again at earnings periods and you start dissecting it, you're going to find that even though a stock, and I'll zoom back out to Amazon over here, even though the stock has had an astounding move from literally in the last 3 years from 300 to 900, you know, hey, the stock is up 300%. The earnings periods were generally speaking very much close to a coin flip. The bullish earnings announcements, the bullish gaps did slightly outweigh the bearish gaps in both Amazon and Google over the last 3 years. When I say slightly, if you go through and you count 10 different earnings periods, you know, you were getting like basically 6 out of the 10 were actually gapping to the upside, similarly to what we found inside of Google. So it left us in a position of like, okay, so how are we going to trade this? Now, I'm going to present a couple of different trades because I tried to look at earnings announcements, all right, as a bit of a shot. And yet people still want to talk about them, so it's fine. You know, there's a couple things you can do in earnings announcements. And earnings announcements, they break down into one of 4 trades. What is the 4 trades? Okay. You can get bullish. That's the up arrow. You can get bearish. All right. So here's the bull trade. Here's the bear trade. Then you can kind of get neutral. Now there's 2 different types of neutral. There's neutral where you want us to stay inside of a range. And then there's neutral where you want us to go outside of the range. And that basically means either I'm a seller of premium, okay, or I can actually buy premium and hope that we crack the range and move outside. And these trades really break down, again, very, very simply. You know, there's this large feeling that, you know, when people are trading, I'm missing out if I'm not trading earnings. Well, okay, you're not missing out, but it is kind of fun to have some skin in the game. Like I don't mind having skin in the game, and I'll place a couple trades on Wednesday, I'll trade, for a Wednesday night, earnings. And coming into tomorrow is obviously Thursday, and the Amazons and Google and Microsoft are going to have earnings after the bell. So I'll place a few trades for skin in the game. This is not going to be like this huge money-making experience, and I'm not going to put my own neck on the line, because I think you have to recognize you do something wrong in a $900 product, that's going to be the last wrong thing you ever do. First of all, okay, there's a $35 expected move, okay? Respect it. It's a $35 expected move on a 54 vol. Now, respect that. That's actually on a percentage basis not that big. Not that big compared to what? Well, you go over to Amazon and then you start looking at a stock like Tesla. Now, Tesla, it doesn't have earnings right in the near horizon, but earnings are coming up on Tesla next week. And Tesla's a $300 stock with a $21 expected move. So that's getting a little bit more serious. And I just wanted to kind of compare and contrast, okay? But the reason I'm mentioning this to you is you don't want a situation like Caterpillar. You're like, well, what happened in Caterpillar, Don? Well, here's Caterpillar. The expected move in Caterpillar the other day was fairly negligible. And it made almost a 3 deviation move. Okay? What that basically means is, if an expected move is like $3 and the thing moves $6, okay? And you can go back and do some of your own homework. Obviously, the earnings just came out the other day. You can go into Caterpillar and you can literally say, oh, mighty think back. What was the expected move? And the expected move was just shy, okay? It was just shy of $3. $3, $3. There it is. So there's your $3. And of course, the next day, it moved. At one point, it was actually almost $8 on the day. So you're moving at a rate of almost 2.5 times the standard deviation. Now, if you sold options naked in Caterpillar, okay, it was like you got hit by a Caterpillar. I don't know. No pun intended there. Anyway, we go to stuff like Amazon and Google. And again, I'm jumping around a little bit because the trades are the same. Google, okay? And again, let's go back over here to Google L, right? Google has about a $28, $29 expected move. But again, it's like a $900 stock. So you can see Amazon's got a little bit more juice, a little bit more movement. One of the things that I would not suggest in here, okay, I wouldn't go get cute and sell option premium naked. And I know that some people are going to do that. But listen, I can't save all of you. I'll save one of you. I spent 15 years at a brokerage firm. I haven't just heard horror stories. I've seen all the horror stories, okay? And they revolve around Google. No joke. There was one time where we were working and Google accidentally had earnings released. It was actually by an intern, accidentally sent an email that had the Google earnings in it. They were released during the trading session, and Google moved $90 in about 1 second. And then they locked it down, and then it traded even lower than that. I don't know if anybody remembers it, but again, it was in December a couple of years back, and it was a big debacle. But people that sold options naked wiped out in about 1 minute, literally in 1 minute. And it was on Google. I mean, you're like, yeah, it can't happen, all right? No, a lot more can happen. That's only a 3 deviation move over here. So if you're going to sell options naked, okay, you're on your own, baby. I mean, I can't support it because I've seen too many people get run over. So if you're going to sell option premium, what you want to do is probably use an iron condor. Don't get cute, right? You don't have to use like a double diagonal, a straddle strangle swap, a pterodactyl type trade. Just go out there. Listen, this thing's $30, right? Just go just over $30 out of the money, which takes you up somewhere about this 920, maybe even the 925s. Again, when I say don't get cute, okay? Go to like the 925, maybe 930. There's your call spread. Collect $1 on it, right? It's about $30, $35 out of the money. Then do the same thing on the puts, okay? So I can come down, on the puts down to the 60 level. That's 30. So go $35. Go to the 855s, maybe 850s. Done. Okay, here's $2. Here's $2 that you collect. You have about $3 at risk. It's a $5 wide call spread, a $5 wide put spread. So this is your net neutral trade. Now come over here. We're gonna analyze the trade, right? So here is the Google trade at large. It's just an iron condor. There's nothing cute about it. There's nothing really to know about it. It's an iron condor. What does the iron condor do? Well, so long as we stay within a given range, and what's that range over here? Okay, you can see as long as we stay inside of this range, we're going to be in our happy place. Okay, this is our happy place. Anything outside, like, you know, you start breaking outside, even 855, you're going to really feel some pain out there. And, you know, the 925 strike, when you start to crest through that, you're going to feel some pain. If it happens, okay, listen, there's not much defense. You're going to lose basically the $3. Okay, that's it. And does the trade have a decent probability? Yeah. I mean, listen, that's what you get. That's your net neutral trade. And that's selling. Again, that's selling it and hoping we stay in a range. Now, people always ask, well, what's the opposing side of that? You could buy it. If you think Google's going to make a massive move over there, just buy it. That's why it's a fair and two-sided market. Then where's your happy place? Then your happy place is you actually move substantially on either side of the market. Now, what's your bullish trade? What's your bearish trade? Those, keep them easy, easy, easy. Use stuff like in-out spreads. Cut the risk. Don't get cute and try to buy a call or buy a put. Come on. You know what a put's going to cost at the money is like $14. Think I want $14 for a shot? No. Because you don't know anything and I don't know anything coming in here. So these in-out spreads, okay, in many cases, these in-out spreads can be incredibly effective trades for you. So what does that in-out spread really amount to? Well, this is where you're going to go and construct a trade where, again, all you want to do is take a little bit, just a little bit of directional bias without putting your neck out there on the line. And we can use $2 wide spreads. You know, we can use $5 wide spreads. But again, in this particular case, you know, you might be able to go out there and when markets are open, buy like a $5 wide spread. In this case, you wouldn't want to pay. You would not want to pay more than about $2.50 for a $5 wide spread. Now, we can price the call spread or we can price the put spread. Okay. Again, this one happens to be the more bullish trade on the call side of it. You're going to have to play around with the strikes a little bit, ultimately to make the trade fit at that given period of time. You could even do something as wild as a $10 wide spread, but a $10 wide spread is still, it's only going to cost you $4.85. Frankly, I would rather keep it tighter than that. I would prefer doing like a $5 wide spread, but you don't want to pay more than about $2.50 for that. And that will be a trade that you can execute. Again, both bullish and or bearish. Now, let me elaborate just for a moment inside of Amazon, because is Amazon any different? Absolutely not. Okay. I mean, Amazon as a trade, it breaks down identically, okay, from kind of a risk reward standpoint. Here is, and again, this one I've kept even tighter. It's just a $2.50 wide spread. Again, a $2.50 wide spread, you're paying about $1.30 for it. Ideally, I'd rather pay about $1.25 for a spread that's $2.50 wide. That happens to, in fact, be your bearish trade. Okay, what's a bullish trade? Just do the opposite. Okay, literally, they'll price out effectively. Here's a $2.50 call spread for $1.18. Fine, done. You do one or the other. But these are the types of trades that you want to approach earnings with and not accentuate $18 of risk, because for you to put, and think about this, you go out there and buy a call for $18 to make 100% on this trade, you have to have this product move literally, okay, to the edge of expectations and then some. And the probability of that occurring is greatly diminished. Why not just go out there, don't get too cute, and just buy a small spread for like $1? And if you want to allocate more capital, fine, up the number of contracts out there. Don't put your neck on the line for earnings, okay? Again, tomorrow, you've got a lot of order flow that's going to be generated. Obviously, after the market, Amazon, Google, Microsoft, even Starbucks is coming out with earnings. It's the biggest single day. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.